We should be ready to roll here. So good afternoon, everyone. Hope this webcast finds you well. This is the Who Said U.S. Stocks Are Boring, our macro presentation. So we're joined by our U.S. Equity pod to go through some of our most recent research and findings. So I'm Brad Long, Partner and Research Director, overseeing the Global Public Markets Research effort. We have our three illustrious colleagues on the line, Mike Degnan, Colin McGee, and Chris Ledwith. I will largely be playing traffic cop today, so I'll be taking questions and moving around slides. To that end, should you have any questions throughout the presentation, feel free to answer or ask them throughout. You can indicate those in the chat window. We can see them as they come through. If we don't answer your question right away, I promise it's because we've got a slide later in the deck that we think will address it. Otherwise, we'll get to it in live time. Got about 30 minutes on the clock here. Would love for it to be interactive. If not, sit back, buckle up. We've got a lot of fun stuff here. So with that, I'll go ahead and turn it over to Colin McGee. So Colin McGee, you're up.
Great. Good morning, everyone. Just to set the stage here, we'll look at broader equity market performance. So the key takeaways here, equity markets have posted positive returns year to date. Take a look at the top yellow line there. That's Russell 2000 value. The light green is large value. Key takeaway so far year to date is value stocks are indeed not dead. Small value has been leading the outperformance of the broader market. Outperforming growth stocks over the last 6 months, really reversing a decade-long trend as investors anticipate a full reopening of the U.S. economy. If you think about growth stocks, some of the more concentrated names like the Fang M's have been trading relatively range bound year to date. Some headwinds there are, antitrust tensions. There's been concerns over rising rates of inflation, and also just very wide valuation gaps relative to the broader indices. So, we're starting to see some of the forces that have driven markets higher start to unwind so far this year. But during this presentation, we'll unpack a lot of those forces and give some context behind all of them. So the first key theme in broader equity markets is really the index concentration. And it's most pronounced in the core and the growth indices. If we look at the top 10 index weights, the top 10 constituent weights, that is, the S&P 500 is just shy of 30%. That is a relatively new phenomenon. If you look at the dark blue line here, it's been pretty consistently around 20%. So we're seeing that start to tick up. Growth, has been going more parabolic since 2013. And we'll get into why that is, but I guess not to get too far ahead of ourselves, but a spoiler alert is that the Fang M's are a large portion of the index concentration in the top 10. Today, those are around 22%. Looking at the top 5 as a percent of the index, what we did is we looked at 5-year increments here to see the trend. It's really been upward and onward. And in some areas of the market, the levels of concentration can be quite staggering. The top 10 and the growth index are just shy of 50%, and the top 5 of that cohort are around 35%. So given the levels of concentration, it's important to monitor this group of stocks. We've been tracking the Fang M Stocks in particular here. So what we did is we took a market cap weighted portfolio of the Fang M's, and we looked at some historical data and returns based metrics. So since the 2013 common inception, the Fang M stocks have ranked first in the large blend peer group for 7 out of the last 8 calendar years. And we used 2013 because that's when Facebook IPO'd. So that's the common inception date for this group of stocks. But they've performed impressively well. So we're seeing market caps really balloon in this group of stocks. The Fang M market caps are now larger than all the sectors in the S&P 500 except for tech. Even Apple by itself has a larger market cap than the entire energy sector. So that's a relatively interesting phenomenon. It is important, though, to recognize that this group of stocks has shown weakness. So what's really interesting, I ran these numbers at the end of May, and we actually found that the Fang M Stocks ranked 97th against large cap peers, so almost dead last. And now you've seen that pull back up within the last month. Now the portfolio ranks 35th. To put it in a different perspective, year to date, the S&P 500 index ranks 41st. But if you look at the equal weighted S&P 500 index, which we kind of think of the defanged version of the index, that ranks 8th. So that's been performing incredibly well so far this year. It is important to recognize, though, that these concentrated names are a more volatile group of stocks. The excess volatility over the index on average has been 34% higher than the S&P 500. And they're also a much more expensive group of stocks. So the average forward PE is about 67% higher than the index. So that's important to keep in mind as well. We can look at valuations for this group, or for the top 10 stocks rather, over time, just to evaluate relative to the past. So what we did was we looked at the top 10 stocks versus the bottom 490s forward year PE ratio. And what we found was, we're at levels that we haven't seen since 1999. And like the dot-com bubble. So valuations are pretty expensive today relative to the bottom 490. As of June, the relative valuation ratio stands at 1.49, which is right up there with December 1999 at 1.61. So I think it is important, though, to associate the difference in time period and regime, as with any historical set of data. Concentrated stocks today, they are good businesses, though, right? I mean, they're cash generating businesses, and they have diverse and growing business lines in new areas of the market. So that it is important to recognize that they become the top 10 stocks for a reason. So the question is, can they continue to outperform? So we also looked at the relative performance of this cohort, and we found the results actually show a very similar pattern to the valuation chart that we had on the prior slide. Basically what we did was we looked at the rolling 3-year return spreads, just took the rolling 3-year of the bottom 490 minus the top 10. So, if the blue line is above the average, then the bottom 490 are outperforming the concentrated top 10. And what we found is historically, the bottom 490 actually go through longer periods of time where they are outperforming the top 10. So the period of time we've been in recently is actually, it's fairly different than the past. It's really, again, similar to 1999. We're seeing this metric at all-time highs, or at least similar levels to 1999. So it hasn't happened to this degree for quite some time. So it is important to just recognize that it is fairly rare to see periods of time where the top 10 stocks are both highly concentrated, expensive, and are outperforming significantly for at least 3 years.
Great. So next I want to touch on the changing sector composition of the value and growth indices. And we've created a chart on the left that shows the sector differences of the Russell 1000 growth versus the Russell 1000 value, and we break it into tech and communication services and cyclical sectors. And the bars on the right represent overweight to the growth index, And you can see tech and communication services is roughly at 40% overweight in the 1000 growth compared to 2011 when it was just at 20% overweight. And you can see that cyclicals are at 25% underweight for the growth index. On the far right, we show how the sector weightings have changed over time for both indices. And you can just see how dynamic the sector weightings are given the market cap weighting scheme for the index. On the bottom right, just looking at the growth index over time, you can see that tech and communication services have grown from roughly 30% back in 2015 to nearly double at 60% today. And then your cyclical industries have fallen from roughly 20% back in 2013 to closer to 5% today. We've really seen the same dynamic go on in the value index, but to a lesser degree. So we did a similar exercise for the S&P 500, breaking it down into growth-oriented sectors such as tech, healthcare, also included more stable sectors such as consumer staples. And then we looked at cyclical industries such as financials, materials, and energy. And really, we saw a similar dynamic in that index as well. Since the financial crisis, we've seen your growth-oriented sectors grow from roughly 60% of the index to closer to 80% of the index today, whereas your cyclical industries have fallen over that same time period from closer to 40% to just above 20%. So I think this is really important to note because if you think about the S&P 500, there's a lot of talk about how the index is potentially overvalued compared to where it was 10 to 20 years ago. But it's important to note that the index is composed more of growth-oriented sectors that are less cyclical and really do demand a higher valuation multiple. So we want to take some time and think through how the changing sector composition of both of the indices might impact risk and returns going forward. First, we want to look at it from a macroeconomic perspective. And what we did is we looked at periods over 3 months where the 10-year Treasury yield rose 50 basis points and periods where it fell 50 basis points. And what we found is that in periods of falling rates, we've seen growth stocks outperform historically, as shown on the chart on the left, whereas in periods of rising rates, we've seen value outperform. And it's just interesting to note that this dynamic has become more pronounced over the 5-year period, shown the right-hand side of the chart, compared to the 10-year period or since 2010. And next, we just looked at the correlation of the value and growth indices over time. And as you can see on the chart on the far right, the correlation of both indices has fallen over time as the sector differences between the indexes have become more differentiated. So I really think the key takeaway here is we might potentially see greater performance dispersion between the indices as the sector differences have become larger. So it's style diversification is going to be increasingly important so your portfolio isn't overly tied to one macroeconomic outcome. So next, I want to transition over to the growth of the intangible economy. So we looked at the breakdown between intangible assets and tangible assets for the S&P 500 and that asset mix. So for an intangible asset, think about a patent or a brand. For a tangible asset, think about plant, property, and equipment. And today, the breakdown of the assets is it's roughly 85% intangible assets. And that compares to, say, 40 years ago on the far left of the chart on the top right, where the economy was composed roughly 80% of tangible assets. So that mix is essentially inverted. Over this time period, as the economy has become increasingly intangible, we've also seen a demise in the value premium over time. One potential explanation is that investments in intangible assets are expensed rather than capitalized. So your growth-oriented companies that are typically investing the most in intangible assets might have depressed earnings or book values that make them look more expensive than they truly are. Next, one interesting thing we've seen in markets over the past 10 years is what some people are calling the innovation premium. So if you look on the chart on the top left, companies that have invested the most heavily, so at R&D as a percentage of sales, have outperformed by 600 basis points annually compared to the least innovative companies that are trailing by 300 basis points. So it really shows the importance of investments in intangible assets to build dominant competitive positions in this market environment we've been in. So we've seen some really interesting research from academics and investment managers in recent years, just thinking about how better can we account for the growth of intangible assets when constructing valuation metrics or multiples. So an academic at NYU, Baruch Lev, did some really interesting research. And what he did is he capitalized a portion of the investment in intangible assets into book value and used that adjusted price to book value measure. And he found that that measure outperformed your traditional book value measure, price to book value measure in 35 of the past 39 years. And that became more pronounced in time periods when we saw intangible assets become a greater portion of the economy. And then research affiliates did some similar work as well. Their adjusted price to book value measure is shown in the orange line on the chart on the top right, compared to your traditional price to book value measure in the blue line. So next I want to transition to talk, well, actually, let me make sure I touch on the key takeaway here. So we really think there's a tremendous amount of strategies that are based on quantitative approaches that incorporate traditional valuation metrics like price to book, price to earnings, or even measures of quality such as return on invested capital. We think it's increasingly important to talk to managers to see how they're thinking about potentially making adjustments such as these, or really thinking about a more nuanced approach, sector-specific approach to valuation that accounts for that sector's mix between intangible assets and tangible assets. So next, we just want to touch on the disappearance of the value rebalancing premium that I think we don't hear much talked about in the value discussion. So if you think about the value premium, we really can decompose it to two key things. One is just the higher yield of value stocks has contributed to outperformance over time, as well as what people call rebalancing or mean reversion. So essentially a value stock seeing its multiple expand over time. And what we found is that value stocks are staying value stocks longer, and your more aggressive growth, high valuation stocks are staying high valuation, high growth stocks longer over time. And that's shown in the chart on the left. This has also been associated with a declining return on equity for value stocks, as shown on the top right. Whereas for your high valuation, high growth stocks, return on equity has really moved upward in recent years. So there's a few potential explanations for this dynamic. One is that the profitability of the value stocks really just hasn't been strong enough for them to invest in intangible assets. And also we've just seen recently a number of companies that have invested in intangible assets and really built dominant market positions that have allowed them to sustain high returns on invested capital for prolonged periods of time. So next, I just want to touch on two key themes we're seeing in small cap equities. The first is innovation in healthcare. So in recent years, we've seen within the Russell 2000 Growth Index, healthcare grow to roughly 35% of that index. And the biotechnology industry is now roughly 20% of the index as well. That's been associated with growth in FDA approvals, as the FDA has really accelerated the timeline of drug approval. There's also been a number of key technological advances, such as the sequencing of the human genome, and that's become much more cheaper. And there's been a number of therapies that have developed off that, and just a tremendous amount of private equity fundraising as well. So when we think about manager research in small caps and even mid caps today, we think it's increasingly important for managers to dedicate resources to the healthcare sector, because it really can be a potential source of competitive advantage and alpha generation. Next, I just want to touch on the growth of young and unprofitable companies within small caps. Today, over the past years, we've seen the number of companies that have negative earnings continue to rise to roughly 50% as percentage of market cap of the Russell 2000 index, as shown in the dark blue line on the chart on the right. Historically, we've seen stocks with positive earnings outperform non-earners as well, represented by the light blue bar there. But we really hit an inflection point in roughly 2016, where companies that have negative earnings have actually outperformed. And that was really pronounced in 2020, where non-earners significantly outperformed earners in the market. And you can really see what's driving this in the chart on the top right. This shows the percentage of IPOs that are not profitable. And we've seen roughly 80 to 90% of IPOs in recent years come out unprofitable. So they just continue to grow as a percentage of the index, which has a number of implications. First, for quantitative strategies that typically rely on metrics such as price to earnings or return on invested capital, those metrics might not be quite as relevant for small caps going forward, which might present a headwind. And second, there's a number of managers that are quality growth managers that only focus on the profitable segment of the market. Well, it seems like their segment of their investable universe continues to shrink, which might potentially be a headwind for those strategies going forward.
In closing, we just wanted to touch on the growth value cycle. So growth has dominated value over the past 10 years, and it was much more pronounced leading up to and through the pandemic. This was driven by technological disruption, low interest rates, low global GDP. You can see by the chart on the left, growth's outperformance over value leading up to and during the pandemic. News of an effective vaccine in November, however, gave the market visibility to a path of the pandemic, and value has outperformed ever since. These recoveries can be bumpy at times, right? So in the second quarter, we saw growth outperform value as rates declined during the quarter. I would argue you don't necessarily need rates to rise in order for value to outperform. We need them to stabilize a bit. Value has demonstrated the ability to lead in periods with declining rates, most recently in the periods from 2000 to 2007. So higher rates clearly support value outperformance, but it's not a necessity. We also wanted to just give you kind of a snapshot of the pro value periods over the last 50 years. They have on average lasted 62 months and delivered 138 percentage points of outperformance. A sustainable value rotation here will likely depend on a dismantling of some combination of the three drivers of growth. Again, being technological disruption, interest rates, and global GDP growth. Technological disruptions not going away. It's here to stay for the most part, right? Global GDP growth, we saw that accelerate over the past quarter across the globe. And interest rates, well, depending on what you think of inflation, whether it's transitory or not, we could see rates rise in the future, which would certainly benefit value. Over the next couple slides, we just want to talk about some of the tailwinds for value. When value becomes a momentum. So this graph, this table shows the 22-year history of sentiment for value stocks as represented by positive price momentum. So you can see here today, it stands around 30% of cheap stocks are among the high momentum stocks. That's a big jump from a year ago where it was 5 to 10%. So that's certainly a tailwind for value. Valuation and earnings support value as well, right? So valuations. Historically, the Russell 1000 growth trades at 5.6 times multiple point premium to value. It currently trades at a 10.3 times point premium to value, as the chart on the left indicates. Earnings, right? So earnings value is expected to deliver 10.4% faster EPS growth in 2021, as the chart on the right indicates. Cyclical businesses were hit hard by the economic collapse spurred by the pandemic. As a result, cyclical companies whose earnings were most impacted by the lockdown should see the strongest earnings growth as revenues recover and margins and operating margins expand.
So we did get a question that came in just around inflation in value versus growth. I'll take the first run at this here, guys, and then feel free to jump in. But the question from Kevin was, if we head into an inflationary period, how might that affect value versus growth stocks? Well, if you think of the composition of value versus growth, value today is comprised of more cyclically oriented businesses, energy, industrials, materials. Financials could give greater pressure with inflation, could give greater pressure on higher interest rates. Higher interest rates gives greater spread. Financials could potentially have greater profitability associated in that environment. So just from a pure composition of the indices, there's obviously more beta sensitivity to value and inflation than there is necessarily to growth and inflation. But that might be a little too of a simplistic view around just kind of value and growth and the interplay of inflation. Mike, I don't know if you've got any thoughts on the growth side as well and just the potential influence from rising inflation.
Yeah, I would say one thing I wanted to add is, this year has somewhat been evidence of what you said earlier. I think in mid-May, there was this narrative in the market that we reached peak inflation expectations. And it was that at that period where there was a transition from the value-led market to the growth-led market, where we really saw kind of the market huddle into, once again, your FAANG stocks and your stocks with the highest growth expectations. I think if we see, I do agree with what you said, but I think if we see more of a stagflationary environment where there's higher inflation but slow growth, that might relatively benefit growth stocks more in general, because they really, in a lot of ways, aren't really tied. Their margins really aren't hit by input pressures quite as much.
Yeah, stagflation is a great point. The context from which we're receiving inflation, is it high inflation with high growth, high inflation with low growth or negative growth, or is it deflation with high growth or deflation with negative growth? Those all can make a big inference on the potential impact, both on the equity side, which is obviously the value growth conversation as well, but on fixed income as well. Indices of extended duration extensively. There's different inferences there across tips or currencies, et cetera. So it could be an interesting environment. As I think many know, we did have a separate segment. We brought on a great PM that leads the cyclical forum at PIMCO to talk about their view on inflation, how it applies in our portfolios. At the beginning of the year, we have introduced more inflation-sensitive assets for the potential for higher inflation. We don't think it will necessarily get in the way of ultimate portfolio success. But we did realize that the probability of such an environment was rising. And so we took action both across the equity segment and fixed income. Just checking the queue here quickly, see if we've got any other questions on the way in. I know we're bumping right up on time and we want to be considerate of total time. So I would say, there's a number of takeaways from here. We dived into a lot of different topics. Primary inferences when it comes to the U.S. equity market review is that things are not static. U.S. stocks are not boring. There's a lot of change afoot when it comes to not just global markets, but the U.S. equity market. And that includes the composition of underlying indices like Fang M and their concentration. It includes that kind of value growth cycle. It has inferences on how we think about asset allocation, but also about how we think about investment manager selection. We do believe that those that have more of a rudimentary screening process, heavily reliant upon historical earnings or historical book to value, have a greater likelihood of missing different opportunity sets. And so as we're having those discussions from an investment selection perspective, we're bringing those into account. It doesn't mean if you use price to book that you're broken. It means that you have to be considerate of kind of the changes in dynamic, and as the facts change, our opinions change, and we need to be considerate of what is going on around and within the U.S. equity market. So I realize we're at time. We'll kick it there straight at 11:30 Central here. If you have any other questions, we are always available. Please feel free to reach out. Our compliance officer and our lawyers would be very sad if I didn't put up this slide. So not only a thank you, but also some of our disclaimers and disclosures. And as you know, past performance is not indicative of future results. But as always, if you have any additional questions, please feel free to reach out. We're happy to address them. So thanks so much, everyone, and have a great rest of the week.